Hello, and good afternoon, everyone. This is Christina Cuprina, and I'm going to do a little bit of an introduction here in just a moment with our special guest. Before doing that, for anyone that's new to the webinar today, I just want to do a little bit of housekeeping, one of which is any questions you have on any of the content today, please type it into the Q&A window, and I will be sure to answer the questions. Bob Stein, our special guest, who I will introduce in just a moment, is going to be on the first half of today's 1 hour. Apologize for the fact we originally put 2 hours. There's a little story behind that. As many of you know, we hosted a very special event, Outlook on the Economy, for the upcoming year in the beginning of December. Every year where I talk about what I said last year, where I was right, where I was wrong, and then talk about what's likely to happen in the upcoming year. And it's a lot more fun when we get together at a winery or a nice hotel or a nice restaurant and drink adult beverages and eat food and socialize. However, given the times we're in, we're doing this all remotely. The beauty of it is that everyone who wants to can participate without having to get on their car and drive anywhere, regardless of where you live in the country, and you can share this recording later with friends and others. The downside is, 2 hours is a long time to sit on a Zoom. So I thought what I'd do is break it into 2 parts. We're going to do half of it today, 1 hour, and another half in early January. Today, we're going to do 2 things. Bob is going to speak, and again, I'll introduce him in a moment because you're all getting to see him. And after that, roughly, approximately half hour is over, he's going to jump off, and then I'm going to talk about what I said last year, where I was right, where I was wrong, and kind of add to what Bob is going to talk about today. Spoiler alert, I did not call COVID-19, but I did say pandemic. So I'll tell you more about that one later. With that being said, I want to introduce Bob here. Bob is an excellent economist. He and his team are one of the great sources of information and resources for me and my team here at Sequoia. And I wanted to have him speak to you specifically because of Bob's background. So he was the Assistant Secretary of Economic Policy at the U.S. Treasury. He's worked in the Senate Budget Committee in Capitol Hill and the Senate Banking Committee. So he's not only an economist, he's a Washington guy. He knows his stuff. He knows what's going on. And so many of you have asked so many questions about what's going on from a Washington perspective. And I do my very best to answer them, but I'm not on the ground in D.C. like Bob is. So with that being said, I'm going to turn off me for a little while, and we're going to turn on Bob. And please do put your questions in. A couple of you sent questions in advance I think are best for him and not for me, and I'll ask them as we get to the end. And also, again, please chat them in the chat window, and when he's done, I'll bring the questions up. So with that being said, take it away, Bob.
Thank you very much for that introduction. I'm going to share my screen so we can follow along with some of the slides I've been using lately. Basically, let's see. Okay, here we go. Okay, I think everybody should be able to see this now. So in terms of the election results, and by the way, I'm going to talk a little bit about what's going on in the economy. I'll get to that in a little while. I'm going to talk about politics as well. When I talk about politics, I don't talk about my own personal political preferences or what I'd like to see happen. I talk about what I think will happen instead. In terms of the election results, if you're holding out hope that President Trump pulls a rabbit out of his hat and he's the one who becomes president for the next 4 years, your hope is over. Ain't going to happen. Joe Biden is going to be raising his right hand and taking the oath of office on the Capitol steps on January 20th of 2021, and he will very likely be president for the next 4 years. In terms of the House and Senate, however, the Republicans outperformed expectations. In the Senate in particular, they went into the election with 53 Senate seats in their control, a Senate majority. Most expectations were that they would lose that majority and go down to something like 48 or 49 seats. Well, lo and behold, they already have 50 seats in their pocket and may pick up 1 or 2 more seats in the Georgia runoff elections in early January. The way I see it right now, I think there's about a 60% chance, 60% chance that the Republicans win both seats in Georgia I think there is a 20% chance that the Democrats win both seats and a 20% chance that they split. So all in all, an 80% chance that the Republicans pick up at least one seat and retain the Senate majority. In the U.S. House of Representatives, the Republicans were expected, generally speaking, to lose 10 seats in the House. They picked up roughly 10 seats instead. They are now spitting distance from a House majority, from getting to a House majority in 2022. More on that in a few moments. So what are the major implications of this election, assuming I'm right and that the Republicans win at least one of the two Senate seats in early January in Georgia? Well, in terms of the election, I think we're going to get a slender stimulus passed very soon. Slender in the sense that it is not as big as the stimulus that Nancy Pelosi and Chuck Schumer in the Senate, the Democrats, wanted before the election. They were angling for a $2.5 trillion stimulus. Now, given that the Democrats underperformed, given that Christmas is pressing and a vaccine rollout is going to occur over the next several weeks, we're going to see a stimulus, in my opinion, somewhere in the vicinity of $900 billion to $1 trillion enacted before the end of this year. Key takeaways for the next few years, because Joe Biden's in the Oval Office and likely to face a Republican Senate, pending those Georgia outcomes, we're not going to see any major tax hikes. We're also not going to see any trade wars. In terms of tax hikes, as long as the Republicans are in charge of the Senate for the next couple of years, they simply don't have the votes on the Democratic side to pass any of the major tax hike proposals that came from the Biden campaign during the presidential race. What I do think is going to happen is some sort of a compromise on the state and local tax deduction. Normally, the Republicans would not want to increase that tax deduction. And the reason is clear. It's a bigger tax cut for people living in high tax states that tend to vote for Democrats, rather than for people in low tax states that tend to vote for Republicans. But it's still a tax cut. And so I think in the end, the Republicans would agree to something like raising the itemized deduction for state and local taxes from $10,000 to roughly $20,000 instead. In terms of trade conflicts, there ain't going to be any trade wars under Joe Biden for a few reasons. First of all, unlike President Trump, Joe Biden has a preference a political preference in favor of free trade. That's just the way he's voted over the past generation in terms of major trade deals. In addition, the Democratic Party has become much more in favor of free trade over the past generation compared to where they were in the 1990s. Back in the 1990s, Bill Clinton, in order to pass NAFTA, in order to pass GATT, had to get more Republican votes in the House and Senate than he did Democratic votes. It was tough to pull Democrats along to vote in favor of free trade. Now, to some extent, it's the opposite, where the Democrats tend to be more in favor of free trade than the Republicans, back to where we were in, say, the 1950s and 1960s instead. One last reason why there won't be a trade war under Joe Biden, and I hope this doesn't offend anybody, but I tend to be a blunt economist. It's very simple and straightforward. It may sound cynical, but I just think it's realistic. As long as a foreign government hires somebody from the Biden family, whether it's Hunter Biden, his son, or his brother, or anybody else from that family, and pays them very large consulting fees, Joe Biden's not going to have a trade conflict with that country. In terms of big tech, I expect the next 4 years to have plenty of barking, but very little biting. The lion's share of donations from big tech companies, not just Facebook, but Amazon, Google, Apple, the list goes on, went to the Democratic Party and Joe Biden, not President Trump and the Republican Party. The lion's share of their votes from those companies also in favor of the Democrats, not the Republicans. So I expect the Democrats to make it look good, like they're really concerned about big tech, but I don't think they're going to break up Amazon. I don't think they're going to break up Google. And I'm skeptical about the lawsuits that have just been brought against Facebook as well. Lots of barking about big tech, very little biting. In terms of key appointments to the administration, the appointment of Janet Yellen, former Fed chair, to lead the Treasury Department signals that Joe Biden's approach, at least on straightforward economic issues, is generally going to be center left, not far left. He could have nominated Elizabeth Warren. Heck, he could have nominated Bernie Sanders. He didn't in either case. The appointment of Janet Yellen signals he's going to be center left on big picture economic policy, not far left. The bottom of your screen, you'll see that I put entitlement reform with a question mark. It's not going to happen next year. It's not going to happen in 2022. But I do think the stars politically are starting to align so that if the Republicans, and more on that in a second, take control of Congress in 2022, both the House and the Senate, that you could have an alignment that drives significant entitlement reform, Social Security, Medicare, Medicaid, possibly even the Affordable Care Act in 2023 or 2024. I want to emphasize again, not going to happen over the next 2 years, might not happen over the next 4 years, but I can see the stars align for that possibility to increase in 2023 and 2024. The first part of that story is the fact that Joe Biden will be likely a lame duck, probably not running again, in which case, late in his term, he's going to seek some sort of legacy to leave the country, leave the country. In addition, he has a very strong long-term working relationship with a Republican leader in the U.S. Senate, Mitch McConnell. They are personal friends. They may not like each other's politics, but they get along anyhow. It's kind of an old school way of looking at things. From 9 to 5, you're enemies, okay? You're opponents. After hours, before hours, you can be friends, okay? It's a way Americans used to look at things. So I think they have a very sound and strong working relationship. They will have disagreements at times. They will have vehement disagreements at times, but they won't get personal the way President Trump did with people both in his political party, much less the Democrats. Won't be as personal. So I think you'll see behind the scenes an ability to get along that doesn't necessarily play with other issues, but on certain types of economic issues and entitlement reform in particular, it could play out in 2023 and 2024. In terms of looking ahead politically, before I get to economic stuff, let's look ahead 2 years into the 2022 election. I think the Republican Party in the 2022 election has about, or the midterm election, has about an 80% chance of taking over the House. Here's why. First of all, they're already right now within spitting distance of taking over the House. They will need 218 seats. I think they come out of this election with roughly 212 or 213. Again, spitting distance from taking over the House. In addition, traditionally, the party that occupies the White House, and it will be the Democrats starting in January, then tends to do poorly in their midterm election cycles. And so the Republicans have a chance to gain in that way as well. Third reason is that the Republicans did very well in state legislative races around the country. Because of that, they're going to hold the pen on redrawing many of the district lines around the country, and that should help them as well. However, if you notice, I only give the Republicans about a 60% chance, not 80, but only 60% chance of having control of the Senate after the next midterm election cycle. Well, that may sound odd. I mean, if the Republicans have their wind at their back for the House, why not the Senate as well? Given the fact that particularly that they may already control the Senate after this cycle. And the reason is simple. Of the 34 Senate races that are going to happen 2 years from now, the Republicans have to defend 21 of those 34 seats. Democrats only have to defend 13. So because of that, that's a little bit of a hill for the Republicans to climb. So I think the Republicans are likely to have both the House and Senate, but more likely to have the House than the Senate. Looking ahead in an additional 2 years, I think Joe Biden is likely to bow out and decide not to run again. If he does decide to run again, he will absolutely, positively, definitely be the nominee of the Democratic Party. But should he decide, like I think he will, not to run against, then Kamala Harris is clearly the favorite. There is one person from outside politics who I think could give her a good challenge, however. I'm thinking of somebody who could easily self-finance, who's very intelligent, who would satisfy the public's need to see an accomplished celebrity who could potentially swing Texas in the Democratic direction and could appeal to many voters in the suburbs. The person I'm thinking of is Mark Cuban, the entrepreneur and now the owner of the Dallas Mavericks. I think he would have a shot in 2024 if he were to challenge Kamala Harris. I have no idea whether he's going to run or not, but I think his name is going to start appearing more in presidential stories over the next couple of years before he were to make a decision. In terms of the 2024 race for the nomination on the Republican side, right now it's absolute chaos, and it's going to remain that way for the foreseeable future. The first hurdle is whether or not President Trump wants to run again. If he does, and that will probably clear out a lot of the field, if he decides not to run, then it's complete chaos. You may have Donald Trump Jr., you may have any of these other 20 names on the list. Look at the state of Florida. Rick Scott, former governor, now a senator, he might run. Marco Rubio, the senator, little Marco from 2016 may run. Ron DeSantis, now the governor of Florida, all Republicans, he may run as well. And that's just the state of Florida. So there's absolute chaos on the Republican side if Donald Trump decides not to run. That said, if Kamala Harris is the nominee for the Democrats, I give the Republicans an edge. I think she's a weak candidate. She was amply funded in 2019 and 2020. She ended up bowing out before Iowa because her campaign was run very poorly. In the end, campaigns are creatures of the people who lead them. In terms of the U.S. economy, we've come out with some forecasts recently. I think the U.S. economy is going to grow 3% next year. Now, that might not sound like an economic boom, and it's not. It would be, if we're right, the best calendar year for economic growth since 2005, 16 years earlier. In addition, we expect job growth to be very rapid. It may pause temporarily at the beginning of the year, but I think it would pick up by the middle of the year. We're likely to pick up around 525,000 jobs per month. That's the equivalent of 6.3 million jobs next year. By the way, that would be an all-time record. I think the unemployment rate, which is now 6.7%, will finish next year in the vicinity of 5%, significantly lower than it is today, but not quite as low as it was pre-COVID-19. Remember, everybody, it was 3.5% before COVID-19. I don't think we're going to get there next year. I do think we might get there by early 2023, maybe late 2022 at the earliest. In terms of inflation, we expect more of it, higher than it is today, not very high by any historical standard. The Federal Reserve, according to its forecast, says we're not going to see 2% inflation until 2023. I think we'll see 2.5% at least CPI inflation by the end of next year. In terms of interest rates, the Fed ain't going to raise interest rates next year, period. End of story. Simply not going to happen. I personally believe they'll start raising rates in 2023, maybe around the middle of the year, but that's a long way off. No change in short-term interest rates anytime soon. However, I do expect long-term yields to gradually wend their way upwards over the year 2021 for two reasons. First, consumer price inflation will be picking up and real economic growth will have its best year since 2005. When you have better economic growth, when you have higher inflation, you should have at least modestly higher interest rates. In addition, with each passing year, whenever that first rate hike is going to happen from the Fed, with each passing year, we get closer and closer. So we will be 1 year closer to higher short-term interest rates, even though they're not happening yet. Because of that, long-term interest rates, again, should work themselves higher. Now, again, 1.4% at the end of next year is not something to be worried about, okay? Which is still going to be very low by historical standards. Now, if there's one thing I've been hearing a lot about, it's the federal debt. So let's make this the last thing I'm going to talk about before we get to Q&A. A lot of people are worried that the United States is going to be the Argentina of the 21st century. Our debt is too high. Eventually, we're going bankrupt. The way I like to measure the manageability of the federal debt is to look at the interest cost of the debt relative to GDP. Back in the 80s and 90s, when we didn't go bankrupt, the interest burden was 3% of GDP. This past fiscal year, ending in September, 1.6% of GDP. And with each passing month, the average interest burden continues to fall. Earlier this year, the interest burden month by month was consistently higher in 2020 than it was in 2019. At that point in time, the average interest rate on the national debt was 2.4%. Since then, month by month, not every month, but on average, the interest burden has been lower than it was. We just got data for November. You see, we had lower interest burden. That purple bar is lower than the green bar, lower interest burden in 2020 than 2019. Now, how could that be when the debt's so much higher? It's because interest rates are down. The average interest rate on newly issued debt since COVID-19 hit the US economy, 0.2%. It's going to take several years for interest rates to move back up. I do think there is a problem with the federal debt. I wish it were lower, but the major problem right now is that we're financing it with securities that are too short. We need to issue longer term debt to lock in these low interest rates over a longer period of time. I'd love to stick around, and I'd be very happy to answer any questions you may have.
Thank you very much, Bob. You talk as quickly as I do. This is great stuff. We do have some questions coming in, so I'm going to start with those, and I think 3 that came in earlier. In the interest, as you guys know, in the interest of privacy and confidentiality, I don't say the names when I give your questions out. If you really want me to say your name for any reason, just tell me, say my name. But I just do that so people feel that they can ask any question they want. First question, okay, for you, because you were the one speaking, what would you anticipate to be the economic impact of President-elect Biden's term in office being disrupted or shortened for health reasons?
Wow. Well, I think if Joe Biden were to leave office early, and again, not my base case, I don't anticipate it. He's basically cognitively where Ronald Reagan was in his second term in office. So if Joe Biden only expects to do one term, he should be able to manage. I think he'll run a short schedule, a Reagan-style White House, where his advisors will only bring him issues if they can't resolve it themselves. Okay, he won't be intimately minutely detailed like President Obama was, or George Bush was, or Bill Clinton was. So I think he'll have a relaxed schedule. He'll be able to make it. If he were to leave office, I think it would be a minor negative for the financial markets, for the stock market in particular, because I think they would perceive Kamala Harris as further left than Joe Biden.
Okay, thank you. Next question. What is the likely impact to 2022 and 2024 elections if there's a significant litigation against Trump and members of his family?
Yeah, great question. I personally believe that there will not be any federal prosecutions of President Trump or members of his family. I just think it's going to fall by the wayside. Prosecuting a former president for things that happened before they were president or for things that might have occurred while they were president, it's kind of like what banana republics do. And I think that Joe Biden probably wants to just move on and have him be the focus, not President Trump. In addition, I think many Democrats are thinking, well, we did finally beat him once, we could probably beat him again. So let him wreak havoc with the Republicans by not prosecuting him, and then maybe he'll run again. So they may live to regret that, but I think some Democrats are thinking that. So I think in the end, that's not going to happen, at least from the federal level. It's possible people in New York State go after him for taxes or insurance fraud. There's been a lot of stuff written about that. You have to remember, how you value assets for insurance purposes is not how you value assets for tax purposes. They're two different regimes of laws and rules. Ask yourselves, when you get homeowners insurance, okay, which you're required to do when you have a mortgage, is your home 100% fully valued? Because I've never done that. So the valuation we put on it is different because you want the replacement cost for it. It's not necessarily the market value. And so there are different valuation measures for insurance and for taxes in different circumstances. And a lot of people have heard, there were many years he didn't pay taxes. Well, I own a couple of rental properties in Florida, and I'm cash flow positive on those rental properties every year. And I'm taxable for tax purposes I'm negative. Okay, I have a negative liability for tax purposes because I get to take depreciation, and that is not my only income. So I'm paying lots of taxes every year based on my earnings for the company I work for. But if real estate were the only thing I were doing and had all these properties, I'd be in Donald Trump's shoes. Smaller level, but Donald Trump's shoes. Cash flow positive. I could buy a lot of things, but for tax purposes, I'd be negative. So I think in the end, you're going to hear a lot of stuff. If they bring a case, I think it's in poor form. It's probably the kind of things that some people are usually fined for, not prosecuted for on a criminal basis.
Okay, thank you. All right, next question. What is the likelihood of a spending boom, meaning the large consumer savings due to COVID creates a spending boom in mid-2021?
Yeah, great question. Yeah, I do. The saving rate is significantly higher than it used to be. What I do think is going to happen, though, you have to factor this in, is I think we're going to get this slender stimulus late this year, and that's going to spend out over the course of 2021. I think the next stimulus, assuming the Democrats don't win both Georgia seats, any additional stimulus is going to be very small. The Republicans are going to take a step back and say, hey, listen, the vaccine is the stimulus we need. And so I think that the saving rate is going to diminish over the course of 2021 and into 2022. But in part, it's going to be because the unemployment rate is going to average over that period still higher than the 3.5% we had pre-COVID. At the same time that the federal government is withdrawing help for small businesses because it doesn't need it as much, and withdrawing help for the unemployed because it doesn't need it quite as much, or the unemployment don't need it quite as much. So that will be in part one of the ways that this excess saving pool will be dwindled by the removal of federal support.
Okay, thank you. We got a couple more here. And again, I'm giving all these questions to Bob. So if they're supposed to be for me, you'll ask me a second time because he's here talking. Does China represent an economic threat to the US in the next 5 to 10 years?
Wow, that's a great question. I think China represents a potential military threat about 20 years from now. I don't think it's an economic threat as much. I wouldn't worry. You'll hear these stories about, we owe China so much of our debt. They own so many of our bonds. That's a problem for China, not for the United States. If I owe my bank $50, that's a problem for me. I've got to pay it off. If I owe my bank $1 billion, well, that's the bank's problem, okay, not mine. So I think China really is in a tough position where they own so much of our debt. I mean, if we ever decide to not pay them on their debt, remember during World War II, it depends how old you are, but during World War II, there were Germans and Japanese who owned treasury debt. And we set up something called the Alien Custodian Facility, where all the bonds they owned were paid into the Alien Custodian Facility during the war. They eventually got all their money because they lost. Okay, had they won, they could get bupkis. Okay, so imagine a scenario where China invades Taiwan. We go, oh, Chairman Xi, perhaps you should leave and make reparations to Taiwan because otherwise that $1 trillion we owe you is gone. So I'm not that worried about it. I mean, they'll continue to raise their living standards relative to ours, but they have another big problem, besides the fact that we owe them so much money, which is that the median age in China is now equal to the median age in the United States. Okay, that's a product of the one-child policy for the past generation or so. And even though they're loosening that policy, their fertility rate is really low. So the age profile of their population has gone up. But their retirement ages are lower in many cases than in the United States. So that's going to be a headwind for their economy over the next generation.
Okay, next one. How will climate change impact our economy in the next 5 to 10 years?
Yeah.
We're giving you the softball questions.
Yeah, exactly. So climate change will affect our economy. I don't know whether it's man-made or not. That's a separate issue, and how much of it is man-made. But it will affect our economy. I wouldn't let it factor into your investment decision making. I think that should play a minimum role. I think it will play out over a very, very long period of time. And it's not clear to me that the costs outweigh the benefits for the United States in particular, even though there are places in the world where it will. So, if things play out over a long period of time, my view is that we should be prepared for climate change, even if the world were not heating up right now, even if the man-made contribution to global warming is zero. We should be preparing for climate change, because I think we don't know enough about the volatility of weather patterns over the past several millennia to say with a great deal of confidence that even in the absence of human life, that the weather patterns wouldn't be significantly different 100 years from now. So we should always be preparing for it. And my view is we're getting sidetracked by the view of whether we're the cause of it or not. We should always be preparing for it and hardening things like along the shorelines and elevating things and building de facto dikes and things like that.
Okay, I think I just have a couple more. So, see, I work with very smart people. and everyone, thank you so much. For Bob, it's late out where he is in DC, so he's being very kind to do this. So we're gonna let him get out of here shortly. So if you have any other questions, put them through. The last two that came in, I'm gonna save the hardest one for last. And then this one was, just fun, another one. Will the markets do as well or better under Biden than under Trump?
Wow, that's a great question. I don't know. I mean, we're bullish for the next. Yeah, we're bullish for the next year. We at First Trust spent 8 years under Barack Obama telling politically conservative investors to put their personal preferences aside. Even if you think President Obama is a socialist and he's going to destroy the United States, just put that aside, okay? And reflect on where profits are, where interest rates are. And we were bullish for 8 years. And then we spent the last 4 years telling politically liberal investors that even if you hate the orange man in the White House, it doesn't mean it should factor into your decision-making for investments. And we were right about that too. And generally speaking, there'll be corrections, they'll come and go, but we are bullish right now. Now, if we wake up a year from now and the S&P 500 is at 5,500, okay, and interest rates are at 4% in the 10-year treasury yield, then we'll be telling people to sell stocks and buy bonds, okay? But right now, in an environment with the profit levels as good as we think they'll be in 2021, and with interest rates very low and likely to go up, but not much, we're bullish on the stock market. There will likely be a correction at some point. We have no idea when. Grit your teeth, ride it out, and you'll be the better for it.
Okay, thank you. And now the final question. What are the biggest risks that your to your forecast?
Wow.
What are the biggest risks to your forecast? So
if you notice, I only try to forecast the next couple of years in terms of the economy and the stock market, okay? With the economy, I was just giving you what I thought for 2021 and then giving you a little peek at it maybe beyond that with some other discussion. But I'm only trying to forecast the next couple of years. In terms of downside risk, we just went through a doozy with COVID-19. Let's walk you through a scenario. Let's say that I was the ghost of Christmas future. And last Christmas, I appeared to you in all of your dreams, okay? And I told you, here's what 2020 has in store. I'm not going to tell you what the stock market's going to do. I'm not going to tell you what the bond market's going to do. All I can tell you for sure is that the United States is going to be hit by a global pandemic, the likes of which we have not seen for generations. We're going to be hit by the steepest decline in real GDP for any quarter since the Great Depression in the 1930s. We are going to see massive increases in government debt, the likes of which we've never seen. Now I'm going to give you a choice as the ghost of Christmas future. For the next year until next Christmas, Christmas 2020, do you want to be all invested in stocks or all invested in cash? Now, if you were a sane person and you trusted my judgment about the events, about COVID-19 and the steepest decline in GDP, you would have done what I would have done, which is put all of it in cash, if that's the scenario you're looking forward to. And guess what? You would have been wrong. I would have been wrong too. Okay, not about the scenario. I would have been wrong about where to put the money. Stock market's up 15%. So I don't think, I believe people are too focused on what can go wrong and not enough focused on their long-term planning, which they need to sit down once a year, twice a year, 365 days a year with their financial planner, with their financial advisor, and figure out where they need to be over the long haul. That's what they need to focus on.
Well, thank you. That I think you got the questions answered. You did an excellent job. I really appreciate your willingness to be on this again. I know it's late for you out there, and to be on this call with us today and share your wisdom. And I gave everybody an opportunity to see a different face than mine, as well as your energy and your knowledge and your thinking. So it's really appreciated. And with that, you're welcome to stay, or you're welcome to leave and have dinner with your family.
I'm going to hit dinner.
Very much from all of us here at Sequoia and all of our guests for taking time to share your wisdom with us.
My pleasure. Thank you.
Over. So as I mentioned earlier, just in case anyone came in later, usually we do these outlooks on the economy for the upcoming year in a social setting, in a winery, at a restaurant, at the Access Club, wherever we do them. It's an opportunity for us to have a little bit of a holiday celebration, and also to see one another and talk to one another and drink and eat. And there's more to it than just me talking at you, as I have been over these last few months. So rather than doing a really long presentation and giving everybody massive Zoom fatigue, I thought that I would keep this to the traditional hour and kind of talk about things at a high level for the second half an hour we have, or 20 minutes or so we have left today. And then in January, about the second week, I'm going to go into details, the specifics about what's going to look like. What are the sectors? What is this looking at? What are the risks? Kind of the timing and how things will play out. So more detail. I'll start with the high level, go into detail in the second half, so anybody who doesn't want the detail can escape my geekiness. So, as in tradition, in years past, I will talk about what I said last year at this time at the 3 locations that we did this event in. And then I'll talk about where I was right and where I was wrong. The thing about doing this every year is it holds me a bit accountable. If there's anything that I did say, and any of you were there for it or watched the recordings, that I didn't mention and you want to bring it up, if you put it into the chat, to the Q&A, I will touch base on it, because what I tried to do is keep it sort of light and simple so I have a chance to talk about next year. So first off, I said next year that a recession was not in the cards for the next year, for the year of 2020. Okay, so I'm going to bring that one up right away. All of the economic data was very, very strong. There was no sign of a recession, and we were looking at likely seeing one around 2021, and even then it wasn't going to be a serious one. Okay, I talked about the strength of the economy in many areas and the specific sectors that were likely to grow and do well in 2020. But when I said that, if you recall, for those of you that were there, I mentioned that there are 3 things that show you, or 3 things that cause a recession. 2 I can see coming based on data. I can see the .com crash before it came based on data of excesses. You can see the financial crisis. This country was heading into recession months before the financial crisis hit. And both times prepare people and take action. But as I mentioned last year, the 3rd thing, the black swan, the one outside surprise event you can't see coming, can knock the economy on its back pretty quickly. I was going to say but, I guess I can say but. Very quickly. And that is, as my examples are, like a 9/11 type terrorist attack, a war, say North Korea lobs a nuke at us or we get into a major global conflict, or a pandemic. Now, I did not say pandemic because I knew what was coming. I said it because we've had little signs that that could be the case before with Ebola, with SARS, and we saw, or what could be possible if it ever did become something far more widespread and infecting the world. Well, this did happen, so we did have the black swan event. But then 2 things materialized from that. Number one, the economy underlying was very, very, very strong before the shutdowns begun. So there's two components to it. Even without the government shutting things down, we would have gone into a recession because people would have halted normal activities. But then we had something unprecedented. The governments shut it down. Each state did it differently, and some have increased and decreased their amounts of lockdown. But when you shut down your economy, you shut down everything, your things get really bad really fast. And we had the worst, as Bob mentioned, quarter in economic activity since the Great Depression. But then, after the Federal Reserve stepped in, and you've heard me talk about this multiple times, so I won't continue to say much on it, and actions were taken to kind of put a bottom to it, we saw a recovery from there. And the question I get the most often is, how is it the markets can be doing so well when everything is doing so poorly? It has a lot to do with, as I've said before, the Federal Reserve and the government, and the federal government stimulus that we've had over the year. But the strength of the economy going into it is a big part of the reason. And a big part of the reason as we go into 2021, we're going to have a pretty good year. Now, please understand when I'm talking about this, I'm speaking as an economist in a broad spectrum. I'm speaking nationally, I'm speaking globally. I'm fully aware of the fact, and I'm going to talk about that not all industries, not all companies, not all states, and not all sectors are going to come out of this the same way. Some are going to take about 2 years to recover. Others are already doing better now than they did before the pandemic, right? So next year, what we're going to start to see is some of the ones, the high flyers, are going to start to slow down. Okay, the first areas that will take place are going to be largely in the areas where people are kind of don't have any other choice but to do it a certain way. Okay, they can't go to sporting events, they can't go to entertainment, they can't do that, so what do? So I'll get into that more in the January one, but things that people were doing because there was no other choice, as choice opens up, they'll do less of that. The next area are things that people stopped doing, either because the government said they couldn't do it, they shut it down, or because they were too cautious or afraid to do it. Those will start to recover as the vaccine becomes more widespread. Okay? And the final one is going to be things that just people don't want to do as much now, or much next year, as they once did. There may not be, in fact, almost certainly won't be as much business travel, right? There just isn't as much need for it. Many of you know I was on a plane at least once a month doing something for business purposes. I haven't had to do that at all this year. Do I miss some of the camaraderie? Yes. Do I miss seeing people in person? Yes. But I think it's unlikely, highly unlikely, that as things open up again, I'll be doing anywhere near this type of travel I once did. And you know what? It's kind of nice. It's sort of relaxing to be able to do more this way. I'd rather see all of you than get on a plane and go to another business meeting. So that being said, there's going to be things that people just figured out better ways to do, and businesses and even governments, and just simply will not go back to as quickly. And maybe 2-3 years down the road, that will change again, because there are also cyclical habits and behaviors change. This is more in relation to the vaccine. With 6 vaccines in process right now, and either in stage 3 FDA trials, or I think today the first one officially approved in our country for distribution, it will take time, as we all know, to get everybody vaccinated, but just the process of that beginning is going to bring confidence. So there's 3 layers here to our recovery. One is government action. It is highly likely that a form of stimulus will take place before year end, and another one will be forthcoming next year. This will help the industries and the people that are most affected to get through this time until the vaccine can be more widespread. That's going to be the first stage. And the next stage of it is there are people that are not doing things because they can't, and there are people that are not doing things because they're very, very, very cautious or even afraid of the virus. So as things open up, the first wave of people going out and doing more regular activities will be the people that are not that concerned about the virus, or people that are vaccinated. After that, as more and more people become more comfortable, as there's less and less issues with the virus, things will open up. This is assuming, again, the government's open things up. So you've heard my shark story before. If there's been a shark attack, not everybody goes back into the water right away. First the brave, then the timid. And it will be very much the same thing with a lot of activities. Even with the vaccine, people will still be nervous. What if it doesn't work? What if the vaccine makes us sicker? What if? Which is, we'll slow down some of this. I can tell you there's a tremendous pent-up demand for people to travel recreationally, and I think that's going to pick up a lot faster than maybe some other areas, as again, when people feel safe to do so. So the other question, of course, that kind of ties around, all of this is the government itself. When will they feel safe opening up? We have this now very big increase in cases around large parts of the country and a lot of shutdowns happening again. Is this going to delay the recovery? In some ways, yes, and in some ways, no. Interesting thing what's happening is that there are some states that are very, very open, that have made, mask wearing and distancing, but not shutting down businesses and companies and whatnot. And those states are actually doing fairly well economically. They have less effects. Other states are far more shut down. The impact on those states is going to be much more meaningful for a longer period of time. I won't get into what is the right or wrong thing to do because I believe that's the responsibility of our leaders. However, there is a big economic impact as governments, city, state, and whatnot, can't print their own money. And the revenue lost from people leaving the state because they can't earn a living, they can't afford to live there, or their company can't be open, to other states will have an impact. And not a week goes by that we don't hear about another big company leaving California. Is this going to be something that's more sustained or not? We just don't know. But this all will have a financial impact on California. And the federal government's appetite for bailing out cities and states will be limited. So it's a really big tight pickle that the cities and states are in. Lock down more to try to minimize the spread, open more up to help the economy and the businesses not go bankrupt. And this is the balance that's taking place every single day within our leadership. Though I'll make a snarky comment and said it would help a lot if they would follow the rules themselves. And I'll leave it at that. Overall, the numbers that Bob mentioned for the GDP, we're looking, and again, I get information from a lot of sources and pay a great deal of money for it. And Bob and his team at First Trust are really, really smart. But I want to kind of pull that in with some other information as well. Cumulatively next year, on an annualized basis, 3 to 4% GDP. Okay, it depends on a lot of factors we can't yet see. But all sectors will not reap the benefits. The important part is knowing when to move out of things that have done very well this year that are going to stop doing well into next year, and moving into the things that are going to start doing well next year. And just like there's waves of the virus, there's literally waves of this recovery. And so far it's been playing out pretty much as expected, as data has been showing, and it will continue. This will accelerate next year. So you want to be sure you're on the right tile in the game as this is happening, because there's also a lot of risk out there. There's a lot of companies that are staying afloat, issuing a lot of debt, and there's a lot of companies that are trying to catch up, and they're not necessarily doing a good job, and they're burning through a lot of money. So it's not a rising tide will lift all boats. Some boats are going to sink to the bottom, and some are not going to go anywhere, and others are going to move forward. And who that is constantly changing. That's going to accelerate a lot next year. So I've got my work cut out for me continuing to do, as I've done this year, of moving us throughout the sectors as this happens. As Bob mentioned, we're going to get some volatility here. We're going to have some big drops. So it's going to look great by this time, the end of the year. But in the meantime, we're going to get those drops. I apologize in advance for the discomfort that you may experience. If you don't want to feel those drops at all, please let me know, and I'll get you more conservative before they happen. But the hard part about that is if I get you out, it's really hard to get you back in at the right time. So hopefully I've got everyone lined up properly with their risk tolerance, and your investments are positioned to weather the bumps, because they're going to come, but also position from the upside and take the advantage, regardless of your risk tolerance. Conservative, the most conservative of my clients, there's risk in the bond markets as well, and there's opportunities. So you don't have to be into stocks to be well positioned, and also to benefit from what next year will be. But do know there's going to be bumps, there's going to be bad news. I am making up an example, the first person who dies after getting vaccinated because they had a bad reaction. I'm not saying that's going to happen, but it could well happen. An allergy or something we don't know, or a reaction that we don't know. And that news is going to be terrible news, and it's definitely going to have an impact. There's all these sorts of other things that could pop up. So not smooth sailing, but overall strength. There's a lot of money waiting to be deployed. I spoke about this before. I know Bob spoke a lot about the politics. You see, with a lot more knowledge than me. Look at all of the numbers that he brought forth, plus the names of the people. Going into next year, we're going to see, because I will change a lot of these projections if something does happen and we go a lot more blue than purple. Okay, because the power to be able to initiate or implement a lot of these tax policies will have a pretty significant impact on the economy. I will not go into the social aspects of that. So I want to see if there's any questions. Type them in, and I'm going to go forth with the questions that were sent to me in advance. Interestingly, I may not answer all of these because I think some of them were addressed, and there was, very much in alignment with a lot of this. So if I don't get to all of them, that may be why. How long will it take to open businesses and the economy? I really have no idea, because I absolutely have no idea how they decide when to close it. The metrics keep changing. It used to be the hospital beds, and then it was case rates, and now it's ICU units. And I actually really don't know. I'm still, as an economist, and I'm not a healthcare worker and not an expert. And if any of you are, type in the answer to this question, because I'm going to do my best here. The hospitals were given $1.7 billion in the CARES Act to be prepared for the surge everyone knew was coming in the winter. And yet we still find ourselves in the position of not being prepared for the surge in the winter. So that makes it hard for me to know. Now, the hospitals have not yet gone and cut out elective surgeries for the most, and almost all. There's a couple of exceptions there in the United States. That would free up tremendous capacity if that was done. That is really damaged the hospital significantly financially, doing that back in the spring, so they really don't want to do it now. But I would imagine if we really get dire with hospital space, the first sign that you'll see is going to be the elimination of the rescheduling of elective surgeries, at least past the winter surge. But that's something that was kind of a metric that we thought was solved for with all that money and the planning, and apparently that wasn't the case. So the government also keeps changing sort of what the metric is, which means I really can't with any realistic knowledge about above anybody else's try to guess when things will open up. I don't know if it's a significant decline in case rates. I don't know if it's a certain number of people vaccinated. Like I said, I don't know what goes into any of the decision making, and it's so random and it's different throughout, even within the state of California, much less the rest of the country. Let's see. Biden's tax cuts. I feel like I've talked about that one before, and I don't really think there's been any more news or information. He hasn't really brought up what he's going to do yet. So I'm going to save that because it's such an important topic, I'm going to save that for as we get into his tenure and to kind of see a little bit more what he's talking about. Also, the results of the election on the 5th I think it's the 5th of January in the Senate will be before our next talk, and that might we can talk a little bit more about that then. Rolling out the vaccine, how long will it take and who will get it? I know nothing more than been reported in the news on this one. The idea, I think, is that the most vulnerable and the healthcare workers will be the first, and then I'm not quite sure what the next groups will be. It's going to be a great challenge because the more bureaucratic they make the decision-making process of who gets a vaccine, the slower it's going to be. It's just the reality of it. The more paperwork, the more arguing, the more debating, the more bureaucracy that gets in it, the slower the rollout will be. So hopefully it'll be something very simple like age, health risk, something like that, where they can just be done uniformly. But I have no more knowledge than anyone else does. It hasn't really come up in any of the economic aspects. Hopefully sooner rather than later, and to as many people as possible. I do know that the current administration has said that they want this to be something that people don't have to pay for, so there's not going to be a financial constraint to people getting the vaccine. We'll see logistically, it's going to be a significant process. I know there's been a lot of work done about having it administered in a lot of different locations, like even drugstores and the like. So people smarter than me are working on this, and I hope it will unroll well, but I have no more information than the news. Alrighty, last question. Which sectors will outperform or underperform? Ooh, I'm saving that one for January. I have a pretty good idea at this point, but I'm going to save it because it's a kind of a longer talk. And it's something that's going to be better understood as we go into early next year. I have a pretty good idea. I've modeled it out, and I change my model literally every week as I get more economic data. But the thing I want to stress the most is it's not going to be everything recovering at the same time. Every sector is going to be different, and some are going to take at least 2 years. And I'll talk more about what the risks are to that as well. Is I'm a little more bearish than Bob was about when the Fed, about inflation. I think that we may see a bit more inflation than he thinks, but then he also mentioned he expects the Fed to move up rates quicker, which is also a sign the Fed's concerned about inflation. So we may be more aligned than I think. But that's going to be a challenge because many people have not lived through through an inflationary period. Or if they have, they were younger and it didn't affect them as much because they weren't living off of their income. And so I'm going to save the inflation one as we get later into the year, but that's going to be one of the longer term bigger risks here, more than the debt issues. So with that being said, I didn't get any other questions here. Hopefully everybody's were answered. And if there's anything else that comes up that from what was said today, anyone who watches this recording later has questions, do not hesitate to reach out to me. I love answering questions, okay? If you're not a client of mine, just reach out to the person you got the recording from and they can get the question to me. More than happy to answer them. In a time of so much negativity in the news and so much, I would say, disinformation, truly, I want to be a voice of optimism, but reality as well. I want to be an economist that has people say, this is good, or this is not so good, but I know how we can get through it. Adaptability is key. We've all learned that lesson this year. Adaptability is key. The more adaptable you are, the more likely you are to survive and thrive. Which is an interesting fun fact. I think the word is zoonotic. Zoonotic. Zoonotic is the biological or epidemiologist word. I read a lot, study a lot, but this is not my expertise. When a virus jumps from an animal to a human, and it makes it human can become a host, and there's a lot of chance in that. And the more complicated the virus is, the less likely it is going to be able to jump hosts, because if they're less complicated, they replicate a little oddly each time, and it makes it more likely to attach to the new host. So go for it, Christina. You just use the coronavirus as a metaphor for 2020. That's what I came up with. Adaptability is the opportunity to thrive in an unfamiliar environment. And the businesses and the individuals that are adaptable are the ones that are going to go through this, because what comes next is when we get through this, past the COVID's not an issue anymore, things aren't going to look like they did in early 2020. They're going to look different. Some things will be the same, but a lot's going to be different. And being prepared for that is going to be the key to great mental, physical, emotional health, and to thrive in what comes next. The last thing I'd like to say is my holiday and New Year's blessing to all of you in what is going to be a very strange holiday for all of us. What I'm wearing now is probably as dressed up as I'll be this entire holiday season, as it may be true for many of you as well. I am so incredibly thankful in the confidence and the trust that you've placed in me during a very, very challenging year. Know how much attention and intention I put on all the work that I do for each and every one of you. I am so thankful to be in service during this time and to be able to help others. And I am truly thankful to each and every one of you and your confidence and trust in the work that not only I, but the team in Sequoia does for you. I wish all of you a happy holiday, as happy as we can make it, and be prepared and optimistic for what comes next in 2021. Thank all of you very much for attending. Follow up with your questions, and I look forward to talking to you in a couple weeks. All right, bye for now.